Welcome to The Explainer. Today, we are diving into a financial tool that's literally been around for generations, yet somehow it still manages to confuse a lot of us. I'm talking about whole life insurance. We're going to completely unpack how it actually works, who it's really built for, and most importantly, how you can structure it to fit your exact needs. Let's jump right in.
So, imagine this. What if your life insurance offered guarantees that outlasted the stock market's wildest swings? We live in a world of constant, and I mean constant, financial volatility. But what if you had a true financial anchor? A tool that offered strict, unbreakable guarantees no matter what the market is doing on any given Tuesday? Well, that is exactly the premise of the product we're exploring today.
All right, here is our roadmap for today. First, the whole life guarantee. Then, who benefits the most? Next up, structuring premium payments, followed by enhancing with policy writers, and finally, comparing your insurance options.
Section 1. The Whole Life Guarantee. Let's look at the fundamental mechanics of lifelong coverage.
Okay, so the absolutely crucial takeaway here is that whole life is permanent. Think of term insurance kind of like renting an apartment, right? It covers you for a set period and then your lease is up. Whole life, on the other hand, is like owning the house. It provides coverage for your entire lifetime with fixed premiums, acting as a permanent, lifelong financial anchor, as long as you keep paying those premiums, of course. And this right here is exactly why we call it an anchor. It offers three massive guarantees. First, a guaranteed death benefit for your beneficiaries. Second, guaranteed cash value growth that actually accumulates on a set schedule, completely ignoring stock market crashes. And third, guaranteed fixed level premiums. Your costs aren't going to suddenly spike just because you get older or your health changes. It is pure, predictable stability.
Now, the scale of this coverage is incredibly wide. You can start with a $50,000 policy just to cover basic final expenses. Or if you happen to have a massive estate to protect, you can scale this all the way up to $10 million. It's really built to fit almost any financial footprint, big or small. Moving right along to Section 2, who benefits the most? We'll see how whole life fits different life stages.
It's honestly fascinating how this tool adapts as we age. If you're a young professional, say 25 years old, you might use it for stable cash growth safely tucked away from market fluctuations. Fast forward to your 40s or 50s, and it becomes this vital tool for retirement planning or building a legacy. By 65 and into retirement, it naturally shifts into a really powerful estate planning vehicle. And for the business owners tuning in, it's a seamless way to ensure your business survives a tricky transition after a passing, simply by relying on those predictable premiums.
All right, Section 3, structuring premium payments. Customizing your financial commitment.
Now, you might be wondering, do I really have to pay this bill every single month for the rest of my life? Well, actually, you have two main funding paths. You can absolutely choose lifetime premiums, where you just pay a fixed amount indefinitely. But you can also choose limited pay premiums. This means you only pay for a specific number of years, or maybe up to a certain age. And the best part? Once that period is over, no more premiums are ever due, but your lifelong coverage remains fully in force. Let's break down those limited pay options, because there's a really clear trade-off here between your annual cost and the total length of your commitment. A 10-year pay means your cash value accumulates super quickly. But yeah, your annual premiums are going to be much higher. A 20-year option gives you a really nice balance of cost and steady growth. Paying up to age 65, that aligns perfectly with your critical working years. And finally, paying to age 100 gives you the absolute lowest annual payments, but it requires a very extended commitment. And let's be real, nobody really wants to be paying an insurance bill on their 99th birthday. Section 4, enhancing with policy riders. Let's talk about dividends and customizable protection. Okay, this is where you can really optimize the whole shebang. Many whole life policies offer non-guaranteed excess credits, which are usually just called dividends. Now, you can just take the cash option where the insurer pays that straight to you in cash. That's great. But alternatively, you can use what are called paid-up additions. Think of this like a clever financial compounding hack. You take that dividend and you reinvest it to buy micro chunks of more permanent insurance. Over time, this actively snowballs your total cash value and your death benefit. Beyond those dividends, you can completely customize your umbrella of protection using riders. Imagine facing a chronic or terminal illness and actually being able to accelerate a portion of your death benefit to help pay for care while you are still alive. You can do that. You can also attach term insurance for your kids, automatically waive your premiums if you become completely disabled, lock in the right to buy more insurance later without any new medical exams, or even automatically donate a percentage to charity. It's literally built around your life. Finally,
Section 5, Comparing Your Insurance Options. Let's find the right fit for your goals.
Context is everything, right? So, how does this actually stack up against other permanent options, like indexed universal life or IUL? Well, as we've seen, whole life is all about absolute certainty: guaranteed premiums, guaranteed cash value, zero market volatility. IUL is a bit different. It shares market risk with the insurance company. And because you're taking on that risk, an IUL could potentially offer better cash value growth over, say, a 20-year stretch. It entirely comes down to your personal risk appetite versus your desire for a strict, ironclad guarantee. But if there's one core takeaway from our source material today, it's absolutely this: any life insurance policy is better than no life insurance. Whether you end up choosing a simple temporary term policy, a guaranteed whole life anchor, or a market linked IUL, simply taking action, getting something in place to protect your family and your future, that is the most vital step you can take. So I want to leave you with this question to chew on. What kind of legacy do you actually want to leave behind? We've seen how whole life can act as this customized, lifelong financial anchor structured perfectly to your timeline and protected against the unexpected. But the next step? That's on you. Take a hard look at your own goals, weigh your options, and definitely keep learning. Thank you so much for joining me on this explainer, and I will see you next time.